Are undeposited funds confusing to you? Do you have a mess in your bookkeeping system where undeposited funds should be zero and it's not? Today I'm going to explain how to use undeposited funds and how powerful it can be to save you so much time in your reconciliation at month end and to keep your books clean and tidy. All right, let's jump right into the video. If you haven't yet subscribed or rung the bell on my channel, do so now so you don't miss out on future videos. Okay, so I'm very visual, and so I'm going to use some graphics to give you examples. Whether you sell products or services in your business or both, let's say that in 1 week you had multiple transactions where you either did some kind of income generating activity, whether products or services or both. And you have some cash that came in, you have maybe some cash in coin, or maybe you have some checks. Now, we're not talking about payments that go directly to your bank. We're talking about physical payments that come to you, whether it's mailed to you or handed to you, that you put aside to deposit at a later time into your bank account. So I have an envelope here, whether you have an envelope, a cash box, or you put money in a specific place in your drawer so that when you go to the bank, it's ready to go. This is what I'm talking about. Multiple transactions, physically in hand, that will be deposited at a later time. All right, so I'm a numbers gal, so let's add some numbers into the same example so that it just makes it more simplified. So maybe you have, from the same week of transactions, you have $100 in bills, maybe you have $250 in some cash and coin, and you have $650 in check. So throughout the week, this money has come in and you've put it into your envelope that maybe is titled to deposit, or it's in your drawer, and it totals $1,000. All right, it is time to take that money to the bank. So you have this envelope where you've got the money that you collected from multiple transactions that you're taking to deposit into your bank. Remember, in total, there's $1,000. So when you deposit that money in your bank account, if you're not recording it anywhere else, it's going to show up as one transaction, one deposit for the total amount in your bank account. Here's what happens is that your numbers don't match. So when you come to reconcile your bank account at the end of the month, which I highly recommend and require that you do in your business, you've got that $1,000 deposit sitting on your bank statement. But how do you tie it back to the money in the transactions that generated that deposit? If you look on the left, I have in the mix those three amounts, the $250, the $300, and the $650 that make up that $1,000. But hold on, hold the front door. There's two transactions for $250. Which one do you pick? So it becomes this puzzle and kind of a mess that we want to simplify for you and make it easy so it all links and ties out so that your numbers do match. Okay, so let's look at that same transaction. Same situation, same money, 100, 250, 650. We're putting it into a bucket inside our accounting system in addition to the envelope. So you still got the envelope, but in the accounting system, you are putting it into a category, an account called undeposited funds, because it's to deposit in your bank account. So whether you're using QuickBooks or Xero or another sophisticated accounting system, they all have undeposited funds. You classify it as it's basically your to deposit bucket, right? But your accounting system also recognizes it, not just your drawer or your envelope. So before you take that money to the bank, you go into your accounting system and you create a deposit form. And what happens is you'll say, okay, I want to deposit these 3 transactions that you've recorded in your QuickBooks and you've put into undeposited funds. And it generates a deposit slip for you and ties those 3 transactions to that one deposit. So when you go to the bank and you take your envelope and you take your $1,000 to the bank, your bank still sees one transaction of $1,000. But when you go to reconcile your bank account, your numbers match because your QuickBooks has already tied out that $1,000 deposit for you. So it will recognize that there's $1,000 deposit on your bank statement, and hold the front door, we created a deposit in QuickBooks already that was $1,000 made up of these specific 3 transactions. There's no guesswork. It's already tied out for you. It moves the money from undeposited funds now into your bank account. So that is where you are going to really see the benefit. It's tying the transactions from the detail to the total that's going into your bank. But when do you not use undeposited funds? Well, when do you not need to deposit something? Let's say you get a transaction where someone pays and it goes directly into your bank account. You're not putting it in your envelope. You're not putting it in your drawer. You're never holding physically onto that money. It's going a one transaction from a payment source to your actual bank. And you really don't have to do much other if it's a one for one. Now, if there's some merchant fees subtracted from it, you'll have to deal with that as far as like adding a little entry to account for those merchant fees. But let's just say you sent an invoice to someone for a service that you rendered and it was $250 and they paid either with a credit card that went straight to your bank or an ACH payment or through your QuickBooks accounting system, one for one transaction where the transaction amount equals the bank deposit amount that your bank recognizes. Money never physically touches your hands. You do not use undeposited funds for this. It's directly deposited. So there's no to deposit anything. It just goes right into your bank. But how do you classify it for income or transfer? You want to avoid double counting. So as an accountant, I usually sometimes get brought in to fix messes. And undeposited funds can be a mess because if you categorize the transaction as income when it hits the bank and when you categorize it as income when you receive it, you can be double counting. So let's talk about how to avoid doing just that. Okay, we're back to the same number, same transactions over a week. When you're providing these products and services and you're receiving money for products that you've sold or services that you rendered, you're getting that money. So you're recording it as income. You're recording it as income as you put it into undeposited funds in QuickBooks. So the cash for the one transaction, the cash and coin, the checks, they're recorded as income with the offsetting account undeposited funds. Now, when you go to the bank and you've created that bank deposit form, remember we talked about you do that first so that it ties everything nice and neat. You've already recorded that money for income. So when it hits your bank statement, it's truly a transfer. You're just transferring it from one bucket to another. In your accounting system, it's going from that undeposited funds category, account, bucket, whatever you call it, into your bank account bucket category. So it is a transfer at this point and should not be also recorded as income because you've already recorded it as income when you first received it. Remember when we talked about not to use undeposited funds when it goes directly into your bank? Well, now you have never actually touched it. You've never recorded it. So as it is deposited into your bank, then you do record it as income because it's not a transfer. You need it on your books to record it as income if it's directly paid to your bank. So not when you use undeposited funds, it's recorded as you receive it, as it goes in your drawer, as it goes in your bucket or your envelope. It's recorded as income because you've provided the product or service and it's been paid for. When you don't, it just goes straight to the bank. You don't touch it. Then you record it as income when you've received it into that bank if you're on a cash basis. So what do you think? Was it simplified? Does it make more sense? It's really just a way for your accounting system to tidy things up. What you just need to remember is that as you receive money physically and it's to deposit, you classify it as your undeposited funds. You record it as income. And then before you take it to the bank or before you scan your checks to deposit, whatever you're doing for your deposits, you go into your accounting system and you record that deposit. It's going to tie everything out, and it's going to make your life so much simpler when it comes time to the end of the month. And make sure that when it is recorded in the bank, if it came from undeposited funds, you don't also count it as income again, so it gets counted twice. Those are the biggest mistakes I see, and hopefully this visualization and examples simplified and explained it for you. If you have any questions, let me know. You can always book a strategy call with me by going to my website at juliemerrill.me. Have a nice day.